This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for your support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BobbyKKRAFT. You're listening to episode 186. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. We are officially 2 weeks away from the SNN Network Summer Virtual Event 2021. The full event agenda is now live, so go on our website at conference.snn.network and check out to see all the themes and topics for the panels and keynotes, as well as the latest list of the presenting companies that will be joining us. Booking one-on-one meetings with our presenters is also now open, so if you're thinking about participating, now is the time to register and set your schedule and availability. If you'd like to participate, please click the register button on our event website, conference.snn.network. You will have access to all the company presentations, keynotes, educational panels directly on the conference website on each day once you are logged in. You will also be eligible to request and conduct one-on-one meetings with the presenting company management teams. So for the event, to register, go to conference.snn.network, click that register button, and I'll see you all there. Now, for this episode of the Planet MicroCap Podcast, I spoke with Srivatsan Prakash. He is the host of the Market Champions podcast and an aspiring fund manager. Not only has he discovered the fun and joy of investing at such a young age, he started a podcast to actively learn from great investors. Some even have been guests on this pod. As you will hear, Sri is incredibly passionate about investing, microcaps, and at 17 years old, Sri is well on his way to an incredible career, and I feel privileged being able to follow along. Thank you again for tuning in to episode 186 of the Planet MicroCap Podcast, and please enjoy my conversation with Srivatsan Prakash. Welcome back to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BobbyKKRAFT. And joining me today is, I think officially, my youngest guest. I have to check my records and talk to Michael Liu and see if he might have had you beat. I can't remember exactly, but nonetheless, I'm really excited to have on today Srivatsan Prakash. He is a 17-year-old aspiring fund manager, host of the Market Champions podcast, which he started while he was still in his crib, as well as a self-described value investor. Sri, thank you for joining me today, man. How you doing?
Hey, I'm doing great. Thank you so much for having me on. Really excited to be here.
It's great to have you on, man. And we gotta start off. Hey, congratulations! You just graduated high school, so Now you're free. Yeah. You can do whatever you want.
Yep. Thank you.
Do you still want to be a fund manager?
Yes, sir. Of course.
Oh, good. Okay. All right. Just making sure, now that you're free, you're like, all right, there's all these possibilities. Do I still want to be there? So it's good. All right.
Absolutely. Yeah.
All right. Good stuff. Well, again, thanks for joining me today. It's going to be a lot of fun. I'd love to start with your background, man. I mean, look, you're only 17. So I'm assuming, I don't know if it was that long ago, but like when did your passion for investing start, or how did it start?
So I guess the right way to answer that is probably so when I was younger, so let's say about 4 years old or so, I knew the capital of pretty much every country in the world, and so I was basically engrossed in how the world works from like a really young age. And so when I was in grade 1, I was about 5 years old, I got an atlas, and so I basically knew the atlas inside out within like a few months. So I guess I was just really engrossed, number one, in the way the world works, number two, what goes on in different countries. And So that's sort of where like the initial interest about investing sparked, but it was not like officially, investing. It was not officially reading financial statements or anything of that sort. It was just being interested in the world around me. And um, so when I was about 13 years old, I picked up my first investing book because I was reading about this guy named Warren Buffett, and it's sort of like the intersection of my interest and like how the world works and like the ability to make a lot of money, which is sort of a really good thing that comes along with being an investor. And so I pretty much picked up my first book about investing when I was 13, and so it was a book called Finding Number One Stocks by a guy named Kevin Mattress, and he was the president, or he is the president of a investment research firm called Zacks Investment Corporation, and so that's sort of where it really got started, and that's sort of what propelled me into investing. And then I've just read pretty much anything and everything, and even to this day, I still keep learning about what all goes on in the world, and reading annual reports every single day, trying to learn more about businesses, trying to learn more about the economy, so on and so forth. And I've read what I would consider sort of the more common books on investing, The Intelligent Investor, Security Analysis, The Warren Buffett Way, The Essays of Warren Buffett, Peter Lynch's books, One Up on Wall Street and Beating the Street. And I think George Soros's book called The Alchemy of Finance, that was, another brilliant book. And one thing that he shares in that book is he sort of has a trade journal in the middle of the book. And so he basically shares his life thought process as he made decisions. And I know this is like a microcap and stock picking kind of podcast, so I guess
well, not so much stock picking, but investing strategy side of it. But we started microcap. We've been covering everything else since. But yeah, sorry, I interrupted.
No worries. So he basically just shared a couple of things, and as you probably know, in the 1970s, we saw a great amount of inflation, and then the early 1980s, we saw rates go sky high in the U.S. to sort of bring down the inflation, and that caused the dollar to go very, very high. And Soros made a bet in 1985 that all the central bankers would bring the dollar down, and that sort of got me really excited, and watching The Big Short and so on and so forth. And that's pretty much how I got to where I am today. And then about 2 years ago, I started the podcast. So initially it was called The Elite Investing Show, and about, I guess, a year or so back, I switched the name from the Elite Investing Show to Market Champions because, well, primarily, number one, I wanted it to be sort of, before it became Market Champions, I would cover sort of all the aspects of businesses. So, I would have people who ran like social media marketing agencies, and people who are just general entrepreneurs with, without anything, without like them doing anything related to investing. And I would have investors as well, but so after it changed to Market Champions, I've just had investors from all walks of life. So I've had value investors. I've had a guy who runs a value fund from Hong Kong, and then I've had some macro guys as well. And so it's been a lot of fun overall. So yep.
So all right, well, I was going to quickly ask, you said you studied the world and all the capitals. So I'm going to do a quick test. What's the capital of Argentina?
Buenos Aires.
There you go. Okay. Uruguay.
Montevideo.
Oh, I knew it was Montevideo, but I wasn't totally sure. Okay. All right. Good. All right. So, okay. all right, everybody. He's telling the truth. He knows the capital.
Yep.
Everybody, that's good. So okay. You're 13 years old. You're looking at the world around you. It's a much bigger. There's so much more to the world than just what you're learning about in high school. How did you balance, wanting to go off on this hobby that takes a lot of work and time and passion to want to understand more, while also balancing like, hey, I got homework. I got a test tomorrow. Like, so what did you do? Did you just say, all right, I'm not going to do these other things. I'm just going to do this.
So that's a good question. And so from 2009 to October 2018. So I was born in 2004. So 2004, just for context. So so from 2009 to 2018,
I hope everybody just felt that too, that he said he was born in 2004, because that was the first time I felt that. I think I might have just. All right, I'm sorry. I felt that age thing. Okay. Anyway, sorry. Continue.
Yep. So from '09 to from 2009 to 2018, I lived in Singapore, and and then in October 2018, I moved to Canada from Singapore, and so I basically found out about investing and started learning about it when I was in Singapore. And so why that is significant is, so when I was in Singapore, Singapore as a whole sort of has like really kind of hard academics. So they sort of teach, they sort of, hit way above their level. So they teach you like differential calculus in grade 10. And in Canada, they teach you differential calculus in grade 12. So what happened was, so the first 1 year or so when I was in Singapore and sort of discovered this passion for investing, I didn't have all that time to read. And because, there's a lot of academic pressure. So, but then when I moved to Canada from Singapore, I already knew the stuff they were teaching in high school. So that was sort of a really good, benefit of coming here and, on the side. So I had all the time to sit down, just read about investing and, interview people. And so that's sort of how that, came to be.
That's awesome. I love
Yep.
that. So, I mean, listen, man, why didn't you want to learn about investing from, TikTok or, some of these other things? I mean, why did you want to, who gave you the roadmap of like, hey, no, you should read these books maybe to kind of get you started? Because I mean, it's so easy to get all this information to learn about investing. And I joked about that, but in all seriousness, there's some really great TikTokers out there and some great YouTubers that have some great content and information. I mean, that's your generation. That's how they've been learning a little bit. So what made you say, I'm going to pick up this book and read what this guy Warren has to say about this stuff?
I guess I'm a boomer in a zoomer's body.
That's the title. That's the title of this pod. I'm sorry. You just gave it. I love that.
I guess I've just been reading about everything, and then sort of I've always turned to books when I needed answers ever since I was a kid. So I guess that's sort of that's sort of why I went to books as opposed to videos. And in general, I was sort of more distrustful of videos because a lot of them tended to dedicate themselves to forex trading or binary options or some of those rather shady kind of I do watch like all the Warren Buffett interviews and all the Berkshire Hathaway meetings and so on that were on YouTube. So that's what I use YouTube for. And what I didn't use it for is trying to follow some get rich quick schemes. And I think that was a good decision.
I mean, the fact that you were able to even tell that they were that is I mean, power to you, man. I mean, look, it's easy to get totally confused and and fooled by some of that stuff. So I mean, that kudos just on being able to tell that.
Thank you.
So okay, so you started, then you started the podcast. I think it was January 2019. So
correct.
What inspired you to start the pod? I'm imagining we might have very similar reasons for why we both started our podcast. So I'd love to hear yours.
So the reason I started my podcast was, so a little backstory. I actually got started building this elite investor page on Instagram as opposed to Twitter. And so, as a kid, I was more exposed to Instagram than I was to Twitter. And, I eventually found my way to Twitter over Instagram. So when I was actually building the page out on Instagram, I followed this guy and, he ran a podcast. And so as I was listening to his podcast and I thought, it's really cool. So, he just called up people and then he got to speak to them. And, the other thing that was really cool is, you could get these other bigger names to actually just share your podcast. And that way you also get a bigger audience, not only for your podcast, but also for your page. And, I also figured out that I had the fact that I was 14 when I started the podcast. I had that sort of as a differentiating figure and sort of something that, I could sell. And that's where I got started. So I got started because, there's this other dude on Instagram. He was doing podcasts and, I would listen to it. He did one every single day. And, I thought that was awesome. So I started one. And so the initial days of the podcast, so if you actually scroll all the way down, it pretty much just started with a pair of headphones and, and an iPhone. And all I did was wake up at 5 a.m. every day and then record myself speaking for 15 minutes. And that's sort of I guess the first 2 or so months of how the podcast went, and then it started to get a little harder because either I started running out of topics, or number two, school started to get in the way because I'd still have like final exams and stuff. So and then after that, it shifted to once every 2 days, and then from that went to once a week, and so far I've been able to maintain that once a week. I've been able to do the podcast at least once a week, so
Very
it's
cool.
yep.
Very cool. Yeah, no, I guess what? Who did scroll all the way down? I did. I scrolled all the way down, and look, dude, it's hard starting these things. Like I remember back in the day, like talking about MicroCaps. I mean, how many people are out there to even talk about
Yep.
But I didn't think that at the time. I was just like, okay, it's gonna be a weekly. Get it out there, and like even after the first 8 episodes, I was like, whoa, okay, you gotta. I went to every other week at that point. Like it's hard, man, and finding the right audience and doing all that. But it's definitely the world's changed a lot. In, a year, 2 years, 3 years, 4. I started mine in 2015. So podcast.
I mean, the harder thing is like also to stay consistent, right? Number one, you have to reach out to people, and the problem is, a lot of them are simply they're just not going to respond, or they're going to say no, and then you end up with sort of a process where it just becomes really hard to stay consistent. It's easy to fall off, and in a sense, podcasts have like a really low barrier to entry because anyone could just go onto anchor.fm and start their podcast, but it's just really hard to stay consistent, and that's sort of after a point it becomes easier because then you're able to tell people that I've had all these guests on my show,
Yeah.
and then that's sort of another another way you get to sell your podcast and get other people to come on. But yeah.
Absolutely. All right, so now we're going to get to some investing stuff, investing kind of questions. As I said at the open, and also you mentioned on Twitter and other platforms that you describe yourself as a value investor in U.S. equities. So describe what does value investing mean to you? What kind of value investor are you? You're traditional, like by the book, or do you have some differences?
So I guess I'm somewhat in the middle. So so I guess value investing to me is sort of the definition that Ben Graham gave in his book, The Intelligent Investor, where he said that you need to protect your principal, and then you need to do an adequate amount of so you need to do careful analysis, protect your principal, and hope for an adequate return. And that's sort of what a value investment consists of. And I guess there's many different ways to value invest, and in a sense I like to put things into buckets. So that's something I learned from Peter Lynch. So if you read One Up on Wall Street, he talks about cyclical stocks, and there's growth stocks, and there's turnaround stocks, and he has like 4 more different buckets that he puts them in. And so in that sense, I like to look at, number one, what exactly the thesis is, and then after that look for sort of a catalyst to actually bring the stock up to fair value. And there's different ways to analyze different things. So for example, one stock that I guess I've mentioned to you a couple of times over Twitter DM is a company called David's-Tea, or DTEA. And so that company has 46% insider ownership, which is really good, and I guess that is, in a way, it's sort of a turnaround. So what they did was they had a ton of physical locations. They had about 240 locations, but by July 2020, they required financial reorganization. And if I remember correctly, they also went bankrupt, and they had to and they reorganized their entire company. And so they permanently closed all their U.S. stores and 166 Canadian stores, and they focused on e-commerce and wholesaling. And they have some awesome operating leverage because they're entirely e-commerce based, and they're based online. And the other thing is they have an amazing product as well. And so if you go read the reviews, and if you try the product out yourself, it's amazing. And and so that's sort of an example of a turnaround company. And then another one would be sort of a growth investment. And an example of that would be a company called Smith Micro Software. The ticker is SMSI, and disclosure, I'm long both DTA and SMSI.
Nice, thank you.
And so SMSI, basically, they've got a family safety app called SafePath. So, it's for, parents to, instead of a parent like keeps the app on their kid's tablet and so on, they're able to track what, their kids does, their, the number of hours, so on and so forth. And, that's very useful if you are a parent. And, SMSI is, so what exactly the benefit of SMSI is, you can think of it as sort of a SaaS company. And so for SMSI, most costs are fixed. And so SafePath and Location Labs. Location Labs was an acquisition they did, and that's getting integrated. And so Location Labs. So what they're planning to do is they're sort of getting this out through carriers, and so they're planning to get this out through T-Mobile and probably through Verizon as well. So in a sense, they have a monopoly over all the carriers, excluding AT&T. And what the benefit here is that when T-Mobile actually gets SafePath out, all their marketing is done by T-Mobile, upselling and actually marketing to the end consumer. That's on T-Mobile's. That's what T-Mobile is going to do. And overall, T-Mobile also has a very large bankroll, and so their major competitor is a company called Life360, and that company has to do all its marketing by itself, while SMSI has access to T-Mobile and probably to Verizon as well, because they acquired a company called Location Labs, which does pretty much the same thing, and they already had a contract with Verizon. So in a sense. They've got an amazing amount of operating leverage, and they've got fixed costs, and so I think it could go up to $15 to $25 a share. Again, it's not financial advice, so I think I rambled on a bit there. I'm sorry, but
no, look, you're giving. Listen, you talked about what value investing means to you, and then these are two ideas that demonstrate how you assess the market. I gotta ask. I mean, look, you brought up two micros on a MicroCap podcast. I got to ask you, how did you stumble in? Did you stumble into microcaps, or just based on everything that you learned and then doing some screens? I mean, how'd you get into microcaps?
So that's a good question, and so I guess I sort of stumbled into microcaps. So initially, I was busy reading the annual reports of companies like Coca-Cola, Starbucks, McDonald's, so on. And the first stock I ever bought, which I don't own anymore, was Starbucks. And that sort of did a good job of hooking me onto investing, because I got to buy it at 53, which was right around the bottom. And then it had so this was, I think, in August 2018 or maybe August 2017. I don't remember. It's 1 of the 2 years. And so it had a bottom around $47 or so, and then it just ran up it just ran up really fast to 87, and then so I basically bought at the bottom and then sold at the high, and that sort of really hooked me on. And so I got interest. When I started investing, I was looking at these major companies, these big multi-billion-dollar companies, and I did rather well with them. But then eventually I started reading about, number one, how microcaps were like super inefficient, because number one, you don't have all these big hedge funds covering microcaps, and how it's also inefficient because you don't have all this other money that's chasing these microcaps, and there's also so many more microcaps compared to large companies. So there's a lot more opportunity when it comes to microcaps. And I knew a couple of other people who focus only on microcaps, so it's nice to know them. It was nice to get some ideas and advice from them as well. And that's pretty much how I got into microcaps. It was definitely me stumbling into it. So it was not something that I had from the start. And the other thing was, so on Reddit, there's a subreddit called security analysis, and I promise it's not Wall Street bets. And it's got letters of all the major of pretty much most of the major hedge funds that publicly release their letters. And so on that database, most of the funds that release those letters are small cap based. So when you read those letters, you see that the companies they invest in are typically 100 million, 200 million, 300 million, 500 million market cap. And so what that did was, I was able to read about opportunity, not only opportunity, but I was also able to see that, these hedge funds that were returning, 15, 20, 25% a year, they were all focused on microcaps. So that's sort of another thing that led me into the microcap world, as opposed to investing in large caps, which is where I started.
And what's interesting too, when it comes to, kind of stumbling into microcaps, it's like the deeper down the rabbit hole you go of trying to learn as much as you possibly can about investing, the more you want to challenge yourself a little bit. And I mean, did you see that too? Is like, look, like, I could invest in these $1 billion companies and be fine, but like, hey, I'm 17. I can afford maybe a little bit of risk. I'm passionate about investing. I'm hooked, even if maybe I lose a little bit, which I'll have a question about that in a minute. But at the end of the day, it's like, it's almost a challenge, right? I mean, that's really what you think about when you go into microcaps, because it's not that, they have the statements, they have everything that you need because they're publicly traded. They have to have all that information. But the more you dig, the more you realize, like, wait, okay, I got to understand this a lot better than some of these other bigger names.
So I think, the problem is in a way the opposite, because, for example,
Really?
Amazon has like a shit ton of moving parts, and, as opposed to smaller companies, for example, SMSI, which has, one really good product called SafePath. And so in that sense, it's actually easier. And the second thing that I managed to do was I was able to sort of filter out international companies. So focusing on only US companies, because, number one, they're overall, much less likely to be a fraud than compared to companies in China. Then the second thing that, I did was I read a book called Financial Shenanigans, which sort of also got me interested in stuff like short selling. And I've never actually sat down and short sold stocks, but, it also sort of builds in the lesson that, you should actually sit down, go through the financial statements, look at the management, see, how ethical the company is, and ethical from the standpoint that, they don't cheat and they're not actually a fraud. And so, I agree that, there's a lot of these penny stocks that tend to be frauds, but, overall, if you're able to, understand the financial statements, understand the business, and the management has a pretty good track record of staying ethical, I think that sort of qualifies the business as being okay.
You know what? You made a really good point. I got to tell you, I think that's a really important thing to reframe, is that thinking of, why would you say microcaps are more challenging? What? Because you got to do more work.
Yep. That is true, right? Because you don't have access to a lot of research on microcaps. So, for example, if you wanted to analyze Amazon, you could go on Google, you could search it out, you could search up, Amazon research report, and you probably have 10 research firms putting out reports on Amazon. But that's not true for, smaller companies, and, you have to sit down and do the work. And, fortunately for me, I actually like doing the work. I like to sit down, read about businesses, read 10Ks, 10Qs, read the earnings transcripts, and, read the financial statements, and, so on. But it is definitely a lot more work, but I guess I enjoy doing the work, so it's not work to me.
I guess therein lies the definition of the challenge, right? It's like, hey, you define challenge as doing a lot more work. For me, I'm going to do this anyway, so it's not work to me, so it's not a challenge. So why not go check it out and see, finding some undiscovered opportunities that have maybe potential huge upside. So that's a good clarification. But, what would you say has been your biggest learning lesson so far? I mean, as you said, you've only been doing this about 3-4 years. What's been what have you learned the most about investing so far in your career?
So a few things that I have learned is, when you're right, you have to sort of bet bigger than what you have to sort of, size your positions accordingly. So one thing that I have been is I have been sort of I guess in a sense have been smaller in size, and when I should have actually invested more. And I'll give you an example. So there was a company that I found about 6 or 7 months back, and the ticker is CMLS. And I used to have a position. I'm no longer long, and that's sort of the mistake there. So basically, it was a deep value opportunity. So they had so CMLS. The company's name is Cumulus Media. They were basically a radio station company, and they had some really big names on the show. Like for example, some really big names using their radio station. So for example, Ben Shapiro, who's a noted political commentator, he had his podcast on Jordan Peterson as well. And regardless of political affiliation, that bought them a lot of money. But what didn't bring them a lot of money was the fact that number one, they had a lot of debt, and then number two, so number one, they had a lot of debt, and then number two, the radio business as a whole is dying. And so what they were able to do is, number one, they switched their business model around. So what they were doing is they were rapidly selling these radio stations for cash, and then in place of that, they were starting to go all into podcasting. So podcasting is the digital business, and overall it has higher margins compared to radio business, or compared to radio, which was a dying business. And number two, they had a couple of really big names using their podcast service. So that was really good. And then the second thing that they were doing that was absolutely right was they were paying off debt really, really fast. So they had a load of debt, but then they were paying off hundreds of millions every single quarter, and they were aiming to get debt free as soon as possible. And so it was in a sense a turnaround deep value play. And the book value was $20, and I think the per cash value was $15 per share, and the stock was trading around 5. And so what I did was I bought it, and then it ran up to 8. And then, I sold it at 8, which was really stupid, because after that, all it did was it continued to run up to, I think it's at like $13 or $14 right now. So it would have been a multi-bagger right there. So that is one thing, that I've learned is, number one, allocate properly. And number two, plan your entries and exits well in advance, and, actually like stay patient and hold on. And I think, it's Charlie Munger who said, the money is not made in the buying or the selling, but in the waiting. And so I didn't allocate enough to CMLS. I allocated something really little. So I could have allocated 12, 13% of my portfolio. I allocated, I think, what was it, 6% or 7%. So this had everything going for it. It had the debt being paid off. It had a pretty good CEO. It had was shifting into a high margin business and so on. But yeah, that's one thing that I've done that was really dumb. And another thing that I've done that was really dumb is I'm not gonna name the stock, but there were two stocks that in 2018. So this was in 2018 or early 2019. So this was after, and I had a quote unquote home run on Starbucks. And so I thought success is a lousy teacher, as Bill Gates said. And so I decided to go short two companies in early 2019, right before 2019 was a massive bull market, and I decided to short two stocks simply based on valuation. And I basically lost what I made on Starbucks. So in a sense, I was brought back to square one. But overall, I learned from there. And never short a company based off just valuation. You'll need other things going for it. You'll probably need a catalyst, and you'll probably need the company to be some sort of fraud, as opposed to just being overvalued. So yeah, so this is sort of the biggest mistakes I've made.
Yeah, no. Hey, look, those. When it comes to the mistakes, I mean, right? That's where you said the Bill Gates quote yourself.
Success is a lousy teacher. So
that's right.
Yeah, you learn from your mistakes. You don't learn from your successes, I guess.
That's for sure. Hey, well, I have to ask. I mean, you're looking at MicroCaps as well. I mean, have you ever had a conversation with management or their IR firm yet, or do you strictly just kind of do the work and do your thing?
So what I tend to do is so instead of having like a live call, I usually like email their IR and their CEO, and ask various questions. And so there was what you could call so there was an opportunity in what you could call in a sense a very, very pure value investing opportunity. So So there was basically this microcap company called Westall Corporation that was selling for about $1 a share, if I remember correctly, and it was supposed to be privatized at $1.60. So there was a 60% upside from there. But the clause there was that you could only hold a maximum of 1,000 shares, and says some part of that announcement was a little shoddy. So I had to email the management, and I got to email the CEO. I got to ask a bunch of questions about it, and I got them all clarified. So that was one thing that was holding the stock back, and then the other thing that was holding the stock back was the fact that you could only convert a maximum of 1,000 shares. You can only convert a maximum of 1,000 shares into sorry, you can only let me say this again. You could only convert. So if your position was either 1,000 shares or less, you would get the 160 in cash. Otherwise, you would become a private shareholder, and that's not something I wanted to do. So I bought about as many as I could, and then I managed to sort of get that pure value investment. So I got a free 60% upside. But that would not have happened if I didn't email the management, ask them questions, and ensure that what was going on was correct.
Gotcha. Okay. And are you or were you shareholder of WSTL?
I was, yes.
You was. Okay, gotcha. All right. So another question I had for you is going back to the podcast. Would you say that your outlook on investing or your style, would you say it's changed at all since starting the podcast? I mean, what were some lessons learned that you've been able to glean from some of your guests, which you've had amazing guests on there? There's been a little overlap actually. So I love some of the guests that you have on there. They're good friends. So, I mean, is there anything that you learned from, Maj or who else, or Ben or any of these guys?
Yep. So I think one thing that one thing that I've learned, and something that I would like to seek to incorporate in my investment process, is number one, being what they would call a generalist. So in a sense, not restricting your fund to just trading equities. And I know this is a microcap podcast, but
we're general, microcap and general. Okay, we're doing the micros, but then we're doing okay. All right,
Yep.
that's fine.
Yeah. So I had this guy named Jim Leitner, who in my opinion is one of the greatest investors ever. He was profiled in a book called Inside the House of Money, and so he would describe himself as a generalist. And so what that means is, he would take advantage of pretty much any opportunity anywhere in the world, as long as, it provided returns. So what he's done, he's traded, he's traded, options on euro swap rates. And then, he's also been an activist equity partner in a brewery in Ghana. So he's done all sorts of crazy things. And, the one thing that he said that sort of resonated with me is you could sort of restrict yourself to being, I'm only going to invest in US microcap equities long only. But then, the greatest trade in the world could be, being short the Turkish lira or something like that. And, you always have to keep your mind open, and you always have to keep sort of the opportunity bucket open as well. And I'm nowhere close to anywhere. I'm nowhere close to good at macro. So far it's just been an interest, and but that sort of made a lot of sense, because it also reminded me of Michael Burry, Big Short. He had a bunch of trouble convincing his investors that having a position, what most people consider a quote unquote macro position on the housing market. He had to convince his investors that he was actually still value investing, and not just gambling on credit default swaps. So that's one thing that I've learned, that I think that's resonated with me. And then another thing that I guess and another very important thing that I learned was from Matthew Peterson. I think you probably know who he is, right? Peterson.
Oh, he's the best. I love Matt.
Yep. He's awesome. So what he taught me was what he calls structured value. So what he does is he likes to write puts on stocks that he likes, assuming the puts are overvalued. And I've had a lot of fun doing that. So selling. So every time your stock goes down, or your stock, well, I guess not goes down, but every time sort of the implied volatility spikes and your stock moves lower, you want to be selling puts so that you want to be selling cash secured puts so that so if the stock if the stock goes higher and it changes direction and goes higher, um, you get to keep the premium of the put that you sold. However, if you're forced to exercise, you get the stock at a much lower price. And the one thing that really works for us as microcap investors is the fact that, number one, microcaps as a whole tends to be a lot more volatile compared to large cap companies, and in that sense these options also tend to have a higher implied volatility, and therefore also has a higher value. So what this means is, you could have a stock, that's so you could have an option of a stock that's let's say the strike price is 5, but then you'll also end up seeing that the option is going for a dollar per share. So the total value of the option is $100. So for $500 in margin, you get $100 in premium, and so in that sense, so what happens is your break-even price actually falls from $5 to $4, which is a 20%, which is a further 20% discount on what normally would happen. And so that's something that I hope I haven't made a mess of what I was trying to explain. But
listen, I'm gonna have to rewatch my interview and your interview with Matthew just to make sure that I have it straight. But all right. So Sri, coming around the bend here, you talked about earlier about your investing mistakes and successes already, and from your experience. What would you say of all those experiences, or maybe ones that you haven't shared yet, would you say impacted you the most in your career?
Well, that's a good question. That's a hard one. So I guess number one would be the ones that I've learned a lot from, and I've made a lot of mistakes along the way, and it's only been 4 years. So in 40 years, imagine how many I'm going to make, and we could make a podcast. You could call me up in 40 years, and we could make a podcast just on the number of mistakes I'm going to make. So I guess
I'll hold you to that, but successes, all right.
Yep. So I guess one would be not sizing your positions properly. Number two would not be not staying patient enough. And number three would be what they call in poker. There's a word called piking, or being a piker, and what that means is gambling betting very small amounts, or getting out with very small gains when all the odds are on your side. And I remember one of my friends, started calling me Piker of the Year because I made a really horrible trade. I made a really good trade, and I got out at a really horrible moment. And I could tell you what the trade is after the podcast, but it's so basically everything was aligned, and something that would have tripled my money. I got out for a 15% gain, and that was really stupid. So I guess that's another thing. Number one, always stay. So I guess number one, always stay patient. Number two, bet accordingly, and bet according to probabilities. So value the business, value the bet, and then figure out, and then based on that, figure out how much you're gonna bet, and I guess sit on your hands, and you've got to wait, and you've got to stay patient. It's all really easy to say, but we all know that we have to do it. It's just like putting it into practice it's not that easy, but yeah.
Dude, I think the collective audience is like, oh, come on, Sri, tell us the name. No, I'm just kidding. But those are all really great lessons, and I really hope anybody who's their first time investing or anything like that, take some of what he just said to heart. I mean, look, I know we on the show, and sure, I'm sorry, I'm like kind of speaking to the audience and also having you here with what I'm saying, but like at the end of the day, this is a young man who's already really learning a lot, and getting a lot of the basics, from a very early age. So it's just awesome to see, man. I love seeing it, and I love featuring, young investors like yourself on the show as best I can, so that more people can learn about that there are others their age or younger getting started, and taking control of their own financial freedom. So that's really cool.
Yep, it's been awesome, man. Absolutely.
Yeah. Oh, I'm sure, dude. All right. Well, listen, before I let you go, I mean, what's next? I mean, are you going to university, taking a year? Like what's the plan?
So yeah, I do plan to go to university. So for the next, so for the next 5 years, what I'm going to do is I'm going to do a double degree at the University of Toronto, and
Nice.
yeah, so basically going to study a combination of finance and statistics. So so there's going to be some math involved, and I think I think that would overall be pretty useful because number one, statistics in a sense is sort of applied math in a way, and overall, a lot of these hedge funds, if you're looking for a job as well, a lot of these hedge funds are looking for quantitative skills. So they want you to know how to code. They want you to be good at statistics and be good at to an extent calculus as well. And some of the stuff I learned will probably be useful when trying to trade options as well. So I guess so in that way that's sort of what I plan to do for the next couple of years or so,
Very
for the
cool.
next
Well,
5 years. So and
hey man, I was
yep.
gonna say, look, anything to help with trading options, like for taking. I'm still. The options are still for me,
Dude, yeah, all you gotta do is buy out of the money calls on AMC and you're done.
Yeah, of course, right? Like, totally. So, Shri, with that, man, where can my audience go and find more information about you? Actually, hold on. Before information, last question.
Mm-hmm.
What advice do you have for new investors? That either are your same age, also a Zoomer. What advice do you have for them that maybe want to take more control of their financial freedom but just don't know how?
Yeah, so I'd probably say number one, you've got to always be curious about the world, and I've been lucky to be curious about the world from a young age. But you've got to number one, not only want to know what's going on with business, you also want to know what's going on with the world, and number two, you've got to be passionate about investing. If you're just going in it for the money, and you don't actually like sitting down and reading annual reports, it's probably not for you. There's other options as well, and number three, I'd probably say, read everything you can, regardless of, what it is, and, whether it's some value investing, if you can, understand it and there's not too much math in it, you should probably read it, and you should probably just, sit down and, just read annual reports all day. And at least for me, I spend like every free minute that I have, reading about investing and reading about this or that or the other related to finance. And I guess in a sense, I'm really passionate about it. But I don't know. So you have to be passionate about investing if you want to succeed. And then the last thing would be, always manage risk properly, and don't follow, or don't follow the people who are just buying AMC calls or GME calls and trying to get rich quick. It's really difficult to actually get rich quick. If it was possible, we'd all be doing it. And so as much as people would like to convince you that you could get rich quick, just trading 1 hour a day, or buying specific option, that's just not possible. That's just not possible in the real world. And yeah, that's basically it.
Very cool. Very cool. All right. Well, Shri, with that, where can my audience go and find more information about you, listen to your podcasts, everything they could want?
Yep. So if you want to find my Twitter page, you can just search up ELITE_investor, OE investor. And if you want to go listen to the podcast, you can just search up Market Champions on a platform of your choice, and you can find it on YouTube as well. So shameless plug, make sure to subscribe and make sure to follow on Twitter. So thank
Plug
you.
away, man. That's why you do these things. Come on now. All
Thank
right.
you. And thank you for having me, Bobby. It's been awesome being here. I love your
Awesome.
podcast. So yeah.
Awesome, man. No, thank you for taking the time to do this. It's a lot of fun. And yeah, man, I'm cheerleader over here. Make it happen. Up and coming rising star, dude. I'm just really excited to follow your career.
Thank you.
Shri, thanks, man. Have a good weekend. Okay.
You too.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.